Now we're going to look at Europe and talk about some of the things that are happening in Europe. And this time we're going to talk a bit about the UK, because I think there was an interesting some data that came out that I think speaks to some of the changes that we've not only seen in the US, but other parts of Europe and other parts of the world in general. And an interesting one is, after COVID, how would you feel about working from home 2 or 3 days a week? 61% said positive, and incredibly positive, strongly positive. And I think that's where we're starting to see in general, where some people would like it, some people just, sure, like that's a nice to have. And I think that is why it'll exist, but not to the level that maybe some perceive. It's just going to be a matter of what is your travel time. Because if you're thinking about the UK, what is the average distance driven in the UK to go to work, or the averaged commute time versus other areas? And that's where I think we start to see some of these interesting points. But even in a place like this, you're seeing a positive view in terms of some of the activity and what that would look like. So then when we look at how often would you like to have paid work days at home, and 23% said rarely or never. 1 day per week. It's when you start getting into the 2 and 3, you start coming into a meaningful number where, about, let's just say 29, 30% said, sure, I would take a day or two. And I think that is going to become the balance between fully work from home and where, in terms of kind of where things sit in general. And that's going to be an interesting trend to see how this plays out as people start to return to the office, how much of that is kind of a normalcy overall. Now, the other thing that we want to look at is some of the real GDP forecasts, because you're starting to see some differences. So GDP came out for some different countries. It came out for Germany. So Germany, quarter over quarter, missed estimates. It was expected to be down 1.7%, came in at 1.8%. Based on some of the data sets, it should start to get a bit better. And that's when we start talking about some of the PMI data, where manufacturing slowed a bit, but services came up a touch. And that's where we're starting to see Germany in particular starting to see some of this normalcy, which is why Germany is at the highest level here with that 3.5%. I'm giving relative because others are bigger, but on a what would those impacts be for the EU becomes a bigger subset. Now, the problem is going to be exports, because we also have PPI, which continues to trend higher in Germany and other regions, which is going to put some of those additional pressures on, well, how cheap are those exports? How is that going to see some of that normalcy? Now, when we look at the IFO expectations, we're seeing some of that pickup. So private consumption quarter over quarter was down 5.4%, which will pick up, speaking Germany. Government spending was down to 0.2%, and capital investment was actually up. So that's why which makes sense, because the IFO data has been fairly positive over the last few months. So it's not surprising to see the business climate being talked about being so strong, that's starting to see some of that capital investment, which will help offset some of those drops in exports that we're seeing or expect to be seeing within the German market. Now, when we look at real GDP in Germany versus Italy, this is when we start talking about the EU and really the euro currency, because when you look at Italy, you see that it's essentially flatlined over the same period that Germany has seen some steady increases. And the headwinds continue to kind of roll out. Now, Italy has their PPI coming out, CPI, so we're going to be able to gauge it a little bit differently once that starts to hit the system. Now, but looking at Germany, all of these are moving in those positive trends where you have business expectations going to well past pre-pandemic levels, past 2019 levels. You have business climate well past, back to 2019 levels. You have current assessment still weakening but getting better, obviously, because they're still in some sort of lockdown that is it is expiring, in different locations as the month progresses, to the point that by the time we get to the second week of June, we should see pretty much a full-on reopening. and we'll get a sense of where things are going from there. So this just breaks it down where manufacturing has paused a touch, and that's, I think, makes sense given the fact that manufacturing had the biggest increase. And then services are starting to make up that slack. And I expect to see manufacturing, just given lead times and cost and just slowdowns in general on an inventory level, manufacturing will be flat to down and services will continue to make up some of that lost ground. But that's going to put pressure into trade as construction continues to be bifurcated based on, where you essentially building for the most part, because those expectations have been fairly soft for an extended period of time, not just through 2020. So then when we look at the German manufacturing PMI delivery times versus France, here's just the same type of issues, because rising orders, bottlenecks have led to an increase in delivery times to a new record. Now supply should adjust, and the picture looks very different for services, but this is something that we keep talking about when we're looking at economic growth, economic prowess, and just where do exports go, because the two largest economies of the EU are facing some of the largest lag times, especially Germany, which is why we think that there's going to be the numbers or expectations continue to be well above where they should be at this given time. So then when we look at the change in the ECB refi rate, so the PMI price pressure, so this is looking at something similar where prices are going higher. So inflation is driving up, and typically when you get this kind of move, you can see that there is an adjustment in the ECB's rate. And typically there's a 50 basis point increase. Now, nobody is saying that they're going to increase 50 basis points. It just shows that there is a lot of pressure, and when they've crossed into this kind of level, it usually creates some sort of reaction, and it just shows just how broken the market really is and how you're going to continue to see pricing going higher with little to no adjustment at the Fed level or the ECB level, or insert your central bank to try to alleviate some of these tensions in the near term. And this is part of the reason why, because when we look at total employment, the total employment continues to lag on multiple metrics, on the trend coming from 2007, and then the trend from 2013 to 2019. We continue to see this hesitancy or this employment problem, which is why when we talk about the consumer in Europe, it's a very problematic backdrop, and layer that with new pricing and prices going up. That's why without tourism, without some of this fresh capital, given the hesitancy or the unwillingness or really government restriction, depending on where you live, on international travel, is going to make it difficult to kind of bridge that gap, which is why we continue to see this sluggishness. And this is going to be that overhang for consumer spending as prices continue to go higher. So then when we look at almost all companies in the manufacturing sector have to pay more for intermediate products. So this, again, speaking to what we see in Germany and the Euro area in general, because this is looking at the Euro area, it's just as bad as it is in the U.S. So again, this is why I keep talking about this is a supply chain problem, not a U.S. problem. And as we import from Germany, these pressure points and prices are going to continue to feed down that system. So then when we look at revenues of some sectors have already climbed back to the pre-crisis levels, but some others haven't. So when we look at, when do we see this normalcy in terms of just activity, I think tourism and travel, 15%, think 2021. Most of them are looking at 2022, 2023. And I think the biggest pressure or interesting point is the transport and logistics and automotive, because that is where I think you're going to see the biggest support for higher pressure, just because you're not going to have the supply to close that gap. And that's where I think when you look at retail and some of the bigger ticket items, there's a lot of pressure to see when do we get some of this normalcy, and it's just going to take a lot of time to get there. And this is something that is obviously a European survey, but I think it's something that makes sense going abroad as well, especially when you think about it being done by Germany and where they're seeing it. Now, given the U.S. has gotten a ton of stimulus from a fiscal side, monetary side, so there's a little bit of additional support, but again, that only lasts for so long. So then when we look at the Eurozone core CPIs, that speaks to why we think the CPI levels are going to continue to see that support higher as we continue to see that trend, which speaks to the ECB not raising rates. And that's why the pressure is going to get there. But that'll also feed down into their exports and into the U.S., who buys from the region. So then when we look at Germany Producer Price Index year over year, here's where you're getting some of this additional shift, where the PPI is continuing up, and the expectation is German Producer Price Index 24-month % change. It's been going up outside of just the base effect typically out there, which is why we think that the trend is obviously going to continue and going to put that additional pressure on Germany more so just because they're so exposed to the international market, especially given the supply chain disruptions that we see. Now, this is looking at the UK on primary shopping mode. So when we look past the pandemic, what are you going to do in terms of shopping? And I think it's interesting to see that before COVID, 12% were all or mostly online. 25% will be after COVID. And I think the shift, because people have gotten more comfortable with shopping online, there's still things, I know me personally, I'm always going to buy stuff in person. I like to feel, touch, see it, understand the size, the weight, if it's plush, if it's soft. But I think there's more and more, and this is something that is translating into multiple areas, not just the UK, where we're going to see this additional adoption of online buying, and it's going to replace some of that bricks and mortar and some of that retail traffic, again, putting some of that pressure on the way consumption used to be or the way refined products used to be consumed. So when we look at annual inflation rates, so when we look at the Eurozone, this is, when we talk about some of this perpetual movements, we think that you're going to continue to see this drift higher over the coming months on a year-over-year, month-over-month basis, just based on the PPI supply chain. Everything essentially we said in segment 2 and segment 3 of the econ show still applies, especially segment 2, to the inflation rate and the EU. And this is just looking at the UK, speaking to the same points, because PMI input prices, output prices have now taken out that high, output prices already took out that high, and there's still space to close that gap, which is why we continue to see a lot of this pressure coming through, not just in the US, but again, this is a global issue, and that's going to continue to pressure and press into the system in general. So now after this, after Europe, we're going to pivot into and go and talk more about Asia, and more specifically China and some of the trade data that has come out over the last few days.